Let's talk about what's really going on in the stock market right now, because something big is happening. Most equity markets globally have either entered or are teetering on the edge of a bear market. But here's the thing, not all bear markets are created equal. Some are structural, some are cyclical, and others are what we call event-driven. And where we are now, well, it might have started as one type, but it's quickly turning into something much more serious. So what triggered this sell-off? The catalyst was what some are calling Liberation Day, a massive, sharp rise in tariffs by the US, designed to realign global trade in its favor. But this shockwave didn't stay isolated. It's now reverberating across global markets, dragging down equities, inflating recession fears, and sending valuations into correction territory. Let's break this down. Structural bear markets are caused by deep systemic issues like financial bubbles or banking crises. Think the 2008 financial meltdown. Cyclical bear markets are more common, usually set off by rising interest rates and slowing economic growth. And then there's the event-driven type, short-term shocks like wars or pandemics. Right now, we're technically in the event-driven camp thanks to the tariff escalation. But here's the scary part. If recession risks keep rising, this could morph into a cyclical bear market, and those last longer and hurt more. Now, just how bad is it? Historically, both cyclical and event-driven bear markets see average drawdowns of around 30%. The difference lies in duration. Event-driven downturns tend to recover within a year. Cyclical ones? They often last 2 years and take 5 years to bounce back. But if you're wondering how to tell when we've hit bottom, don't just look at the headlines. Bear market rallies are common. The market can bounce sharply even while the overall trend is down. It takes a lot more than a few good days to reverse a true bear. So, what does signal a turning point? It's a mix of factors. Cheap valuations, extreme investor pessimism, macro stabilization, and importantly, policy support. Right now, the Goldman Sachs bull-bear indicator is still elevated, above 70%. That's flashing a warning. Sentiment is still fragile, and the risks are real. Let's zoom in on valuations for a second. The U.S. equity market has been flying high for nearly 15 years. The result? U.S. stocks are expensive, historically expensive. The S&P 500's forward PE multiple is over 19, well above its long-term average. And even after the recent correction, U.S. stocks are still priced richly compared to global peers. Now, valuations alone won't cause a rebound, but they do matter when combined with other forces. Think of them as dry wood. All you need is a spark, whether that's better earnings, lower rates, or improving sentiment, and things can turn fast. Speaking of interest rates, monetary policy is going to be key to what happens next. Fed Chair Jerome Powell has said he's in no rush to cut rates, but financial conditions have already tightened. If equity markets keep sliding and macro data weakens further, the Fed might be forced to act faster than planned. Currently, expectations are for 325 basis point cuts starting in June, but that could change. Now here's another dimension: investor positioning. Goldman's risk appetite indicator just had one of the biggest two-day drops since 1991. That tells us fear is climbing fast. Historically, when this index falls below 2, it's been a strong contrarian signal to start buying. We're not quite there yet, but we're getting close. And what about the bigger picture? What does this mean over the next 5 to 10 years? This is where things get even more complicated. We're entering what Goldman calls the postmodern cycle. It's a world with less globalization, higher government debt, a rising cost of capital, and capped corporate profit margins. All of that suggests lower long-term returns on equities and a greater need for portfolio diversification. Let's put some context around that. Global interest rates, which have been in a secular downtrend since the early 1980s, are no longer falling. Government spending, especially on defense, is rising sharply. And that's putting upward pressure on long-term bond yields. At the same time, the globalization tailwind that drove margins and profits higher over the past few decades is slowing down. Tariffs are back in fashion, global supply chains are fragmenting, and trade growth has stagnated. That also hits corporate earnings. For years, companies thrived on cheap labor and open trade. Now, with labor costs rising and trade policy tightening, margins are under pressure. That's why revenue growth, not margin expansion, will be the main driver of earnings in the future. So, what's the takeaway? If this bear market does indeed evolve into a cyclical one, it will take time to recover. But even if we're just in an event-driven downturn, the path forward won't be smooth. Either way, this is a wake-up call for investors. Focus on quality. Diversify. Lengthen your investment horizon. And look beyond the U.S., especially toward markets with better valuations and stronger earnings growth potential. This is not 2008, but it's also not 2020. The recovery this time will look different. And how you position yourself now could define your returns for years to come. Thanks for watching, and if you found this breakdown helpful, make sure to subscribe for more deep dives like this. Stay sharp out there.